I think this is the most significant financial crisis in the post-war period.
There are fears the sell-off will continue on Wall Street.
Soaring gas prices, falling home prices, and rising unemployment.
That was a news clip from the great financial crisis of 2008. The 2008 crisis had a profound global impact on the international economy. There were widespread job losses, economic downturns, and collapse of banks and businesses. It has been 15 years since the great financial crisis, and we like to think that our economic systems are more resilient than ever. But are they? Recent signs emanating from the U.S. economy are not good, and some are even mirroring the events that happened in 2008. What are these signs? Do we need to prepare for an impending economic doom? Or are the alarm bells exaggerated? We'll cover all of this and more. Let's start from the top down and explore the recent activities of the monetary policy of the Federal Reserve. Chapter 1. Persistent high inflation and high interest rates. Inflation, a measure of the general price level in the economy, has remained high for a while in the United States. Even if some amount of inflation is healthy for an economy, it generally leads to a number of externalities. Since the price of commodities goes up, the cost of living goes up as well. People's wages or incomes, on the other hand, are not that quick to correct themselves to the increased price level. The result? The general population feels the pinch, and purchasing power of the consumer decreases. Inflation in the US currently stands at 3.1% at the point of recording this video. It's higher than what the Federal Reserve wants it to be at. Ideally, according to the central bank, the inflation in the US should remain at 2%. In their efforts to control inflation, the Federal Reserve has been raising rates, but more or less failing to achieve the desired outcome. And this is not an underestimation. The Federal Reserve has raised the interest rates 11 times since the early months of 2022. Don't you think this has had an adverse effect on the capacity of banks to lend? It certainly does. And it has no plans of cooling down either. The chairman of the Federal Reserve told reporters at Jackson Hole, Wyoming, that he has plans to increase rates further in order to meet the 2% mark. This has prompted fears that a severe credit crunch could topple businesses and cause job losses. The retail business is a perfect example here. According to the Business Insider, in 2023 alone, nearly 2,400 stores have closed down across the U.S. Although the reasons for their closure are varied, cutting costs, bankruptcy, and preference of consumers to shop online have been cited. You might think the businesses we're talking about here might be small, but we're talking about Amazon, Bed Bath & Beyond, and Foot Locker here. You might be thinking, what about small businesses then? Wouldn't they be more affected? Absolutely. According to a report by Statista, inflation remains to be one of the single most important problems small businesses are facing in 2023. There have also been reports of small businesses feeling the pinch in the state of Florida. Persistent rate increases by the Fed, as promised by Jerome Powell, could complicate the issue further. The credit capacity is taking a hit, and as the housing market was a catalyst of the economic turmoil in 2008, the same seems to be happening now as well. Let's explore that in our next chapter. But before we do that, we hope, just as the Federal Reserve, that we're keeping your interest up in our video. Why don't you pause and press the subscribe button while you're at it? Chapter 2. Housing Crisis Deja Vu? The credit crunch is also plaguing the housing market. The National Association of Realtors reports that the median sales prices of existing homes has reached $406,700, only the fourth time the median price has breached the $400,000 mark. In such a scenario, where the sale price of homes is hitting record highs, it's no wonder that home sales are at lows. And when you combine this with the interest rate hikes that have been implemented by the Federal Reserve, the average mortgage rate has reached the 7.36% mark. To put that into context, it's the highest it's been in 23 years. It's no surprise then that not a lot of people are buying homes at the moment. If you're wondering, wouldn't that mean a lesser number of people are applying for home loans? And you would be absolutely spot on. The data on the volume of mortgage applications only vindicates our argument. The volume for mortgage applications has been the lowest since 1995. That's 28 years. Additionally, The last time the real estate market in the US was showing astronomical high prices was in the period of 2005 to 2007, just preceding the great financial crisis of 2008. That is a similarity that we would not like to be seen replicated. Obviously, things have changed for the better now. The economic system is more resilient, and we probably would not be witnessing a similar housing crash as we did in 2008. However, a market correction could well be underway. History has a cunning way of repeating itself, and we definitely do not want to find ourselves in the same situation. Since we're on the topic of similarities, we're going to explore another similarity that has only stoked fears of a forthcoming crash. Let's delve into another case study. Chapter 3. The $1.6 billion bet. The Michael Burry story. You might have seen the movie The Big Short, which portrays Christian Bale as Michael Burry. It's based on a real-life incident of the period before the 2008 financial crisis. Burry was quick to see that the U.S. housing market, built on risky loans, is highly precarious. Sensing an impending market crash by the second quarter of 2007, due to the projected surge in interest rates tied to adjustable-rate mortgages, he placed bets against, or shorted, mortgage-backed securities tied to the market, ultimately aiming for profitable gains. In the end, he ended up pocketing a healthy amount of $2.69 billion. Not bad, huh? And that made him an overnight legend. Since then, his moves in the market have been closely watched, and unfortunately, he's back. In June of this year, it was reported that he has put a position against the stock market. He exercised this by purchasing an impressive 40,000 put options contracts tied to the S&P 500 ETF Trust, or SPY, and Invesco QQQ Trust, or QQQ. We can state that if Michael Burry is still holding his position, he's staring at a potential loss. But if history is anything to go by, we should be vigilant in our approach in the market. You probably might not want to hear this, but there's also one more similarity to be explored here. Remember the iconic building of the Lehman Brothers that was plastered all over the press in 2008? That was the institution that's believed to be the trigger point for the great financial crisis. Similarly, this year alone, 3 big banks have collapsed in the US. It started off with the collapse of the Silicon Valley Bank, SVB, a bank that specialized in lending to the tech companies in Silicon Valley. In the financial turbulence, 2 other banks, Silvergate Bank and Signature Bank, also collapsed, triggering worries in the market. Even though the Federal Reserve was quick to act, and most of the deposits were secured, a collapse of banks means a bailout from the government, which indirectly implies a bailout from the taxpayers' money. A discussion on banks turns our attention to debt, and precisely to a recent downgrade of the U.S. government. The credit ratings agency Fitch downgraded the U.S. credit rating from AAA to AA+. Why did it do so, and why is this even significant? Let's examine that in our next chapter. Chapter 4. Fitch rating downgrade and the way forward. The credit ratings agency downgraded U.S. credibility to pay back its debt from a high rating of AAA to AA+. It attributed this change to the political brinkmanship between the White House and Congress. It also stated that it expected the U.S. economy to slip into a recession in the start of 2024, and warned that such extensive political shutdowns are a bad testament to its ability to pay back its debt. The aforementioned shutdown is the political jostling to raise the debt ceiling every time the U.S. reached its peak. The debt ceiling is the cap on the amount of money the U.S. can borrow through Treasury bonds. When the ceiling is breached, it results in the political tussle to get approval from Congress so that the ceiling can be raised. Since the situation is used to score some political brownie points, it can be delayed, causing government shutdowns, essentially a situation in which the U.S. would not be able to service its debt. That would be catastrophic, not only for the U.S. economy, but also for the world. A default by the U.S. government could send ripple effects across the globe, since many consider the U.S. market to be a safe haven. Considering the debt ceiling has been raised a staggering 78 times, and with political polarization at an all-time high, the times ahead look tough. The veteran investor Warren Buffett also expects a recession just like Fitch. Berkshire Hathaway sold shares amounting to a net $8 billion in anticipation that the stocks would tumble. So what does the way forward look like? There are some gloomy days ahead, But repeated talks of recession and our past learnings have made our economic systems better prepared to absorb shocks from the market. The future does indeed look uncertain, with many gambling on what could happen. One thing is certain, however, that we need to be cautious. An economic storm might be brewing, and it would help our case if we made our investments waterproof when it downpours. If you enjoyed our video, make sure to subscribe and like the video. It sure helps us grow and provide you with better content. Don't forget to click on the bell icon while you're at it, so you don't miss out on our future uploads.